Hey guys, give me a quick confirmation if you guys are able to hear me, see me and see the screen properly. Right, okay, I think so everybody is able to see me properly. Let us start with this session. We're going to be starting out with the topic of basics of portfolio planning and construction. My name is Ganesh Naik and I help finance professionals and students to clear the exam FRM and CFA in the first attempt. Now let us start with this topic. This chapter is basically an area from the portfolio management book where they have already discussed about the risk and return of the portfolio, the basic structure of the portfolio. Now they are giving you some important points to remember if you are going to manage the portfolio of your firm. So how exactly you should be doing it, what is the process that you have to follow. That is the intention of this chapter. Okay, so with this, let us start with the first section of the chapter, okay, where they are talking about the investment policy statement. Now this investment policy statement is an integral part of your entire process of managing a portfolio for your client. The reason being, whatever is your interaction, the initial interaction with the investor, okay, with the client in terms of his understanding, in terms of his risk and return, in terms of his constraints, okay, what is his expectation of the entire process, everything has to be written down into the investment policy statement. And the more very important part that will go inside this investment policy statement is that you will try to understand what is the risk profile of the customer. Is the customer very much risk averse, or is the customer only is willing to take extra risk as per his investment profile? So you will try to judge and you will try to write the structure of the entire portfolio management way in that investment policy statement. That is the intention. Let us read this paragraph and then we'll go towards the components of this investment policy statement. Okay, let us read this first paragraph. Okay, so what does the first two lines talks about? Whatever is a client's requirement, what is a client's need, expectation, constraint, I talked about it, right? So whatever, all of this has to be written down in a standard document so that we, whenever we take decisions with respect to changing the portfolio composition, adding new asset to the portfolio, we can go back to that document to understand what was the actual requirement of the customer. Okay, a written investment policy statement gives you a direction as a fund manager. Okay, what should be the way through which you will be managing the portfolio. That is one part, and more importantly, you will be able to understand what exactly is the goal of the portfolio. Is it stable return? Is it very high return? Is it managing the risk? Okay, and what exactly is the tolerance level of the investor? Like I said, is the investor very risk averse? For example, if the investor is a senior citizen, then he might not be willing to take much risk. But if the investor is very young, then he might be interested to take risk and grow his portfolio. So read this paragraph. This will give you an idea about the investment policy statement. Perfect. Now perfect. So we have covered the first section of the topic and the understanding. Let us go to the major component of the IPS, okay, investment policy statement. Look at the first thing, description about the client's circumstances. When you have onboarded the client, what exactly was his financial status, what exactly was the investment level that he wanted to have, what was the investment objective. Now this is very important. Some of the investors might only want to focus on taking their portfolio to a new level, that means getting higher returns, but some of the investors who might only want stable income from the portfolio, that investment objective has to be defined in that column, the first part. Let us go to the statement of the purpose of the IPS, that is the second section of this entire structure, and where the idea is that if you are going to manage the IPS, you will define why we are doing it, okay, as in fund manager, what it is going to help you with. Okay, so that entire thing is the description or the logic about the IPS, the first 2 points. Okay, let us go to the statement of duties and the responsibility. Now when you are working as an investment manager or fund manager, you have a responsibility towards your client, right? So that you're going to be giving him right information, you're going to be managing his portfolio on his behalf and take the right decision as per the investment policy statement. So all of this has to be written down in a proper structured way, and that is where the duties and responsibility of you as a fund manager towards your client will be written down. And most important of it would be managing the money and managing the asset which is there in that portfolio. So that is basically being written in that third statement. Let us also go and talk about the procedure to update IPS. Okay, so we will mutually decide, okay, on an average every year we would be looking forward to change the IPS, and we would look forward to make sure that the entire process of this revision of the IPS is taken smoothly. What is the expectation of the client and what is the expectation of you? And obviously before that a revision happens, you will send a notification to the client that the revision period is going to come. So we will sit together and change the requirement, change the IPS as per the latest requirement of the client. Let us go to the investment constraints and investment objective. Now both of these points are very important. Okay, now the second last point, which is investment objective, this is again related to the overall first point, but this will give you the entire picture of the objective. For example, the idea over here is to make sure that why we are dealing this portfolio. Okay, how do we want to manage the money and the fund and the asset within the portfolio as per the expectation of the customer. So obviously there will be so many different things, which will also include the investment constraints. Now what is investment constraint? If my investor doesn't want to invest into IT companies, so that will be a constraint, because whenever I create a portfolio, I will make sure that none of the IT company stock is added to that portfolio. That is being written over there. So that these all things will primarily help you create the investment policy statement. These are the basic things. Now let us go towards the further part, okay, which is going to be good to have and very detailed, which will make your investment policy statement very detailed. First of all, the investment guideline. Okay, so if the client has given you the money, if a client has identified, okay, these are the process through which I would be able to do the I want my money to be managed. Now investment guidelines is a process through which I as a fund manager is going to choose funds. What is my logic, or what is my process of identifying an asset, identifying an industry for the market? Okay, so that is the logic. So read this paragraph, you will understand. This investment guideline tells you what is the amount of risk I will take. So leverage, what kind of leverage I am going to take, okay, whether I'll engage into short selling or not, what different types of asset I am going to take. So primarily how exactly in reality my portfolio management will happen, and what is the process of management of the portfolio, that is being given over there. Second last point is the evaluation of performance. Now if I have been managing the fund, there has to be some methodology, some logic which will help you understand if the investment manager is doing good or not. So we will identify the benchmark also, and then at a yearly time or at a 6 monthly time, we'll try to understand, okay, what has the benchmark done and what have you generated as a return for the investor, and then you can compare it. So you will also identify the tools which you're going to be doing to compare the portfolio. Is it going to be Jensen's alpha? Is it going to be Trainer's ratio? So all of this portfolio evaluation process will be taken care at this stage. Okay, and the last and the final part is the appendix of the entire document, which basically tells you, okay, the portfolio allocation process, the metrics of the portfolio allocation that has been agreed with the client will be at the end, which will give the details about the allocation. Then also the process to rebalance the portfolio, which assets they will ignore, which asset they will focus more on. So all of this will go in the end at the appendix. So what I would request you guys is to just read the bullet points which are focusing on what exactly the IPS will include. Read this entire section till here. Right, I hope everybody has been able to go till the points. Now let us go towards the last two lines. Now when we are looking at all of these points, Now the more points that you cover in the IPS, it is better. Now these are just the minimum points that is there, which ideally an investment manager should have in the IPS when he's talking, he's communicating with the client, and he is managing the client's fund. Okay, so these are the last three line primarily talks about that if you have these points in your IPS, then it will make your life easy as a fund manager, and also it will help the client in understanding what is happening with his own portfolio in a better way. Okay, so that's the reason. Yes, that's the reason the three lines primarily summarizes the need for the IPS. Perfect. Now let us go towards the next learning objective. Okay, now over here the very important section which talks about is that when we create an IPS and when we say, okay, we want to identify the risk of the portfolio, we want to identify the return and the risk requirement of the investor. What does that mean? The risk objective, what does that mean? So the risk, when we talk about risk objective, it is basically divided into absolute risk objective or relative risk objective. Now what is an absolute risk objective? Is that, okay, investor is giving you a statement that I want to generate X percentage of return in a month, or for example in the entire year I want to generate 12% of return. So he will have a statement, he will have an understanding about what is the percentage of return that he wants to generate, or what is the minimum amount that he wants to have in the portfolio. Or for example, a customer might say, I want to make sure that my portfolio value doesn't go below a certain level. Okay, so that is being covered over there as a risk objective, and absolute risk objective focuses primarily on your portfolio. You're not comparing it with anyone else. Read this first paragraph. Read the first paragraph, guys. I hope everybody has been able to read that paragraph. Now they have given you certain examples of the absolute risk objective. Okay, now look at this section. Look at this section. Now we can also talk about risk in terms of probability. That is what they want to highlight. So if suppose I want to create a portfolio which will not give me return less than -5%. Okay, but see, you cannot be 110% sure. So what ideally you can create is, okay, I want to create a portfolio where the loss of 5% and below that the situation happening is only 10% or is only 7%. Okay, so they have given you that statement also, which will help you to identify how an investor might think and how you as a fund manager has to take that understanding and write it down. Now over here, since we are only talking about absolute risk objective, it primarily takes into account the individual portfolio of that fund investor. Okay, so look at this this board statement, and also try to focus on these two bullet points. What exactly they are trying to tell you? No greater than 5% probability of return below -5%. That means you losing more than 5% in a year in your portfolio. What should be the probability of that? Very less than 5% chance should go towards that situation. That is what has been highlighted. Now you can talk about the loss of the portfolio in terms of percentage. That is the first statement, because it is talking about -5%. Or you can also talk about the loss in terms of dollar amount. That is given in the second statement. Fairly simple. Now the next part, okay, the absolute risk objective, which we are still now discussing, which is, now this is more about the overall return requirement of the portfolio. Okay, overall risk of the portfolio, and these are generally written in the nominal terms. Okay, I hope you remember basically from our from the previous books. Basically we have the nominal returns, the risk, real return, and the inflation part. Okay, so if you talk about nominal return, it also has the inflation component in it. So normally when you see investors and the investment managers talking, they are primarily focusing on the nominal return. Okay, they are primarily focusing on the nominal return piece. Fairly simple. Let us go towards the relative risk objective. Now this was the second section. The first section was the absolute risk objective, which essentially means if you are managing the portfolio as an individual basis, you want to understand the risk and return of that portfolio as an individual, that was absolute. If you want to compare it if you want to compare it with somebody else or basically some other portfolio, then this is where the relative risk objective will come into picture. For example, generally you compare it with a benchmark. Okay, benchmark it ideally can be an index, S&P 500 or Sensex or Nifty or Bank Nifty. Okay, so you would try to say, okay, I want to generate return which is more than 3% higher than the benchmark. Okay, that is how the statement can be. Read this paragraph, you'll get they have also given you an example. Return will not be less than 12-month Euro LIBOR. So what they are doing is they are comparing the riskiness with the LIBOR return. So I want to get minimum of LIBOR return for 12 months period, and my return should not go below that number. Okay, so that can be one way to look at the riskiness of the portfolio by comparing it with the benchmark. It can be a benchmark interest rate or it can be a benchmark index also, right? So if you read the second statement in that paragraph, it gives you an idea about comparing the benchmark, your risk with the MSCI World Index. Read that paragraph, the entire section. Perfect. Now let us go towards the next paragraph. Okay, let us go towards the next paragraph. Okay, now over here, when we are saying that, okay, we want to have a particular amount of risk as compared to the portfolio, as compared to the benchmark, because we are doing a relative risk assessment, we can also talk about the return of the portfolio by comparing it with someone else. Okay, like I said in the initial part, that we can create a portfolio. We say that, okay, I want to generate a return which is greater than the index, or for example greater than S&P 500 or greater than the 6 months LIBOR rate. So that objective can also be there. That means we can look, when we talk about relative comparison, it can be from the risk perspective or it can be from the return perspective also. Okay, so read this paragraph, the next 3 lines, read the same. Perfect. I hope everybody has been able to read that 3 lines. Simple. Now, lot of fund houses, what they do is, when they are comparing, they also compare it with the peers in the industry. Okay, because they want to be in the top quartile of top 10% of the fund house in their industry, in their country. Okay, so they also want to invest in those kind of assets which will give them the better return. Okay, so that is why they try to create the objective of the return also when they are comparing it with the peer portfolios. That is what is being covered in the last 4 lines. Okay, last 4 lines. Read that highlighted section. All good. Now let us go towards the next part. In an event, okay, where the fund manager, read this section, in an event when the fund manager is primarily is able to match the risk and return of the portfolio with the index. Okay, then we can say that the portfolio manager has been able to generate a decent amount of return by looking at the riskiness of the portfolio and also comparing the return of the portfolio with the benchmark. So that is what the last 2 paragraph talks about, that in any event, the account manager must make sure that the stated risk and the return objective of the portfolio is managed and the client's requirement is mapped. Okay, there is no breach of the client's requirement. That this should not happen, that you are generating higher return but you are also taking higher risk which is higher than what is stated by the investor in the investment policy statement. This should not happen. Read that 2 lines, guys. All good. Let us go to the next section, learning objective 54.D. Now over here the idea is that whether when we talk about risk taking, okay, and we wanted to create the IPS, now I'm going to one step back. That is the first step of the IPS was to understand the circumstances of the investor. Now in that circumstance analysis, we would try to understand, okay, what is the willingness and the ability, okay, of the investor, okay, whether the investor has the sufficient amount of money to invest in the market and whether he has the ability to take that risk, okay. So these two things are covered over here. Read the first paragraph which talks about the ability to bear the risk. Now some investor, okay, they have a nature of okay, take excessive amount of risk because they can bear it, they have the capacity to manage the risk and still go ahead. But there are certain investors who do not want to take the risk, they want to be very, very conservative. So obviously depending upon the financial status of the client, whether he has sufficient amount of wealth, what is the liability that he is having, all of this will create a scenario where the willingness, or so the ability of the customers in terms of risk will get defined. Okay, so read that paragraph. Now you as a fund manager, it is your responsibility to ask relevant questions to understand what is the amount of risk that the investor can take. That is your responsibility. Read that first paragraph. Well, good. I hope everybody has been able to read that paragraph, the first paragraph. Mark this first paragraph as star. Okay. Let us go towards the second paragraph, willingness to bear risk. Now what does that mean? If you have the ability to bear the risk, okay, it might also not necessary that the investor is able to take that risk. Okay, he might not be willing to take that risk. Having an ability and having the willingness to take the risk is two different things. Okay, that is what this paragraph talks about. Even though you have sufficient amount of money, you have sufficient amount of wealth, there is no liability, or majority of your assets are safe, and you have the ability to take risk, but still you might not be interested in taking the risk. Okay, because it depends upon the character of the client also. What is his attitude, what has been his past experience, all of that. So that if you want to understand this better, then you will need to create a short questionnaire, a short list of questions which you can ask to your client to make you better understand about the client's requirement. Read this section, the paragraph. Investors' willingness to bear the risk. So these two paragraphs are important, the ability to bear the risk and the willingness to bear the risk. These two are different part and very, very important section. Mark this as star. Now look at this next paragraph. Okay, so when you are interacting with your customer, when you are creating the IPS, okay, investors' ability and the willingness has to be taken very, very seriously, because this will help you to create that IPS in a better way, because you will be able to understand the constraint better. You will be able to understand what exactly is the requirement of the client in terms of return, or how much amount of risk he can take. Okay, so that will help you to create the IPS better. That will help you to make sure that you invest in the right product for your customer. That is what this paragraph primarily highlights. Okay, so read this paragraph. This paragraph gives you a sectional view that if suppose there is an investor who has a very, very low ability to take risk, then ideally what you would do is you would take his money and invest only in the treasury security or security which are related to risk-free asset, or basically very close to the risk-free asset. But if there is an investor who can take a high amount of risk, then you would ideally prefer equity. Okay, equity, investment into equity, so that he gets a higher amount of return. Read that paragraph which is highlighted on the screen. Perfect. Now this is where the critical part comes into picture. Now you have done your assessment, you have had a discussion with the client, you have got the pointers when we discussed, you asked some question, and then you have come to know that there is a client, he has a high ability, but the willingness is very low, then you can talk to him and you can educate him about the various products which are available in the market, and you can also make sure that whatever misconception that the customer might have regarding the financial product, when you educate him, you basically try to remove that misconception from that mind. Okay, that is one part, that is one section. This is where the role of you or investment manager will become very important, because see, the client might not be able to trust the financial market in that way because of the past experiences. So there you can come, okay, you can come and focus on, okay, educating him. You can give him some assurances, okay, you can tell him, give him some past historical returns and tell him that, okay, this is what has happened in the market, hence your concern about the willingness being very low should not be there. So that is where you will play a very important part. Read this first section, the first paragraph, which is highlighted on the screen, only that part. All good. Now let us go to the last last three lines, which is highlighted on the screen. Now suppose if the ability of the customer seems very low, this is an inverse case. If the ability is very low but he has a willingness to take risk, now this is a very unique situation, because see, even if the customer is willing, the ability is very low, you might not be able to create a portfolio which matches the requirement of the customer. Okay, that is where you have to tell them, okay, this might not be possible. You have to inform him, make sure that the whatever queries that the customer might have, you are making those queries resolved and informing him about the market, how it works, whether because if you want to take risk but you do not have the money, then you should not go and take that risk. That is what this last three lines talks about. Read that last three lines properly. Perfect. I hope everybody has been able to read that section. Let us go to the next part. Okay. In case of any queries during the session, kindly post it in the chat section. I'll try to address it as soon as possible. Okay, Saurabh, I have seen your query. I'll try to answer it after the query in the chat section itself. Okay. Describe the investment constraints of liquidity, time horizon, tax concern, regulatory part. We'll be going to be talking about this in detail in section by section. Let us look at the first part, the liquidity concern. Now, why does this liquidity comes into picture over here? See, you have to think, if you have a client who is going to invest a huge amount of money, he might have certain requirement in terms of having money at certain point in time to fulfill his specific goals or specific ambition, right? He might want to keep certain cash available with him for a short period of time because he wants to spend on certain specific things, right? So all of this, okay, all of this has to be included in your portfolio. That means your portfolio must match the requirement of the liquidity that the client is having. Suppose client wants to invest in only those assets which can be easily converted into cash. Okay, so you would primarily invest into money market security. Okay, during the entire process of portfolio management, there can be a scenario where your client wants to get regular cash flow. Okay, to manage his life, manage his living expenses. For example, if it's a senior citizen, then they might need a specific amount of cash flow to manage medical expenses, right? Or that kind of thing. So that is the requirement that you have to understand from the client, and that will obviously come into picture when you have a discussion, the questionnaire with the client. Okay, now read this first 4 lines of this paragraph. This will give you the idea, the requirement of why we are looking at liquidity in the first place. Read that first paragraph. Perfect. So a lot of customers, they prefer to get regular annual cash flow to maintain their livelihood. Okay, That is why they try to prefer into those assets which will give them good amount of dividend, good amount of interest. Okay, now let us go to the next part of the paragraph. Now over here, okay, look at this section. They are trying to primarily focus on a scenario where, for example, if you have invested into a pension company, or basically if you have invested into certain specific type of product, now there can be a situation where you might immediately need a certain amount of liquid asset to honor the requirement. Okay, so for example, they have given you a reference of insurance company. If you are into a property and casualty insurance, the claim can immediately come, so you need liquid asset to manage that claim that the customer is giving. Now think about this from the portfolio perspective. Now if you want to make sure that your portfolio should have around 20% or 30% of asset which can easily get converted into cash as fast as possible without much loss in the value, so then you will have to think and create that portfolio to match the liquidity requirement of the customer. Okay, if you are investing the money into illiquid asset, that generally happens in an hedge fund, because mutual fund and all this, they try to avoid such kind of illiquid asset. When we say illiquid asset, that can be a commodity, that can be your real estate. Okay, so all of this is very risky proposition. So if the investor is not having the ability and the willingness to enter into this kind of asset, you should not add it to the portfolio. Okay, now read the next 5 lines till here. There's also a section at the next page, so read till this part. Now the last 2 lines, why they're saying that we should not invest into illiquid assets. See what happens if the investor immediately needs money, then you will have to sell that asset. But since the asset is an illiquid asset, you might not get the market properly. So whenever there is a redemption request from the client, that means the client is requesting the money back, you might not be able to honor the request because the asset that you have taken is an illiquid asset. There is no liquidity for those kind of assets. When you go and sell it in the market, you might not get the customer in the right time. Read that entire section which is highlighted on the screen. Perfect. I hope everybody has been able to read this entire section. We have covered the liquidity piece. That whenever we want to create the portfolio, we have to consider the liquidity part. Okay, because that will act as a constraint for you. Let us go to this part, the time horizon. Okay, now time horizon is also an important section where your portfolio composition is dependent upon the time part. Why? Suppose if the investor is having a holding period of 5 years, 10 years, then you are free to take as different variety of asset, because then you have sufficient amount of window to enter and exit the asset, and you can create a portfolio more freely. But if the client is having a time horizon which is very small, okay, then it will be your requirement to invest into asset will also become smaller, because you will not have the luxury to invest in variety of asset. Now they have also said the first statement, read that first statement, the longer an investor's time horizon, the more risk and less liquidity the investor can engage into. Why? What does this first line primarily talks about? Suppose if I want to invest in an asset or in a portfolio which is going to be there for the entire year, okay, or for example entire 5 years, okay, then I can invest into illiquid asset, because then I have an opportunity to sell that within the 5-year asset and generate return. Okay, so more longer the time horizon is there for the investor, I can enter into more risky propositions, and I can also enter into more illiquid asset as a fund manager. Okay, as a fund manager. But if the investor's requirement is very small in terms of time requirement, then you will have to enter into those assets which are low in risk and obviously which are high in liquidity, because if immediately the time horizon is going to complete, you would have to sell that asset and give the money back to the investor, right? So that is where the time horizon plays a very important role. Read this entire paragraph, mark this paragraph as star. All good. Read that paragraph, guys, properly. Perfect. Let us go to the next situation, which is tax situation. Okay, tax situation. Now think about this. If suppose you are investing the portfolio, okay, you are managing the portfolio of the client, and client is into a high tax bracket, okay, then your requirement or portfolio creation will have to take that into account. Okay, because see, when we are reading this content, we are primarily focused on the global audience. Okay, so there might be customers who are US customers. Okay, they are getting high taxed, so they want to invest into those assets which are tax free. So a lot of government bonds and municipal bonds are tax free. So you can create a portfolio keeping in mind the tax situation of that customer. Okay, tax system requirement of the customer. Read this first paragraph, the first point in that paragraph till that section. Perfect. They've given you an example of preferred tax-free bonds. Okay, because if they enter into those kind of assets, they will not be taxed, and that will make the return, whatever is the expected return from that instrument, that will exactly be matching to the what the investor is going to get. Okay, so normal lot of other portfolios or other asset that is available in the market, there might be a situation where there is the return that you're going to be generating, the short term or capital gain, all of this will be taxed by the respective government. So you have to keep that also in mind. Okay, let us look at the last three lines. This last three line talks about the generally investment managers, what they do is they focus on the after tax return of the portfolio over a period of time, and then on the basis of that they try to match the requirement of the customer. Okay, if suppose a customer is a global customer, then you can create the account into different locations where the tax treatment is favorable for the customer. Okay, so that is also possible. Read that last three lines, guys. Perfect. Now since we are talking about the tax part, this section is giving you an example of what all different types of tax related assets are available. Okay, so they have given you a first reference, the first line talking about retirement accounts. So in the US government, in the US market also, there is a government account which is basically a retirement account where you have to put in money, 401k, okay, 401k, where basically your customer can put in some money where it is not going to get taxed, and it is going to get invested in the market, in the bond market, in the equity market. So that can also give him a sufficient amount of return. Okay, and he will also get the benefit of tax exemption. Okay, so they've shown you this line or this paragraph because of the previous section. Okay, now read this section over here. The investor with such account may choose to put security that generates fully taxable income, like for example corporate bond interest, okay, into an account that are tax deferred. Now what does that logic means? So whatever, I can create a structure for the client where whatever income that I'm generating from the investment through bond and other things, even though it is tax, there is a tax requirement that we have to pay tax for that part is getting deferred. That means the structure is created in such a way that you might not have to pay the tax right now, you will defer it for a longer period of time. Okay, so that is being highlighted over here, that there are methods available through which the customer can do that, the client can do it. Okay, look at this section also. While seeking long-term capital gains, okay, tax exemption, interest income and dividend income, okay, into their personal account which has no tax deferral benefit. So what this entire section is highlighting is that you have an opportunity to invest into those assets which has a tax payment requirement, but you can put those account into tax deferral related statuses or tax deferral related accounts where you might not have to pay the income or the tax right now, but you will spread that tax liability over a period of 6 years, 5 years, right? That is also possible. Now this is generally available for a qualified investor. Qualified investor is someone who has good amount of net worth and who is willing to take more risk in the market. So you can read that paragraph. Perfect. Now look at this section, the legal and regulatory requirement. Okay, legal and regulatory requirement. Now this is also very important. See, you have to think from the perspective that if you are managing investors' money, okay, and he is going to we are going to invest through his trust or through other structure. Okay, for example, if you read that paragraph, they have also talked about qualified investment account. That means if you are a qualified investor, okay, so you will have a different benefit and you will have a different set of restriction, okay, as per the legal requirement of the country. So you have to take that into account. What are the rules and regulation of the country where you are consulting the client to invest into, and you have to take that into consideration when you are investing into the different securities and asset. Read that first paragraph, highlighted the first paragraph. All good. The highlighted section, the legal and regulatory part. Now let us go to this section, the last three section. There may also be restriction on the percentage allocation of a specific asset. See, regulators generally create a restriction of investment into particular asset because they want to protect the investor. Okay, because excessive investing into particular asset can increase the risk of the market and also the riskiness of that investor. Hence, if you have to there might be certain restriction in particular countries where you cannot invest more than 30% of your portfolio into a particular kind of an asset, right? So this is primarily there. And also, if suppose your customer is a director of a company, is a head of a company, proprietor of a company, then obviously he will have certain other requirement to follow, okay, as per the securities market rule. For example, in India you have a SEBI, okay, so you cannot engage in such kind of activity which will lead to the breach of the requirement for you as a proprietor or you as a owner of the company. Read that last 4 lines. Perfect. Let us go to unique circumstances. Now every investor is going to be different, right? Every client is going to be different. Now certain client might have their own specific requirement which they want the investment manager to follow, okay, that can be very unique to their own customer. For example, if there is a client which is asking you, okay, I want to do sustainable investing. That means I want to only invest into those companies which are not damaging the environment. That can also be there. There can be certain investors who want to invest into those companies which are not into tobacco, not into alcohol, okay. So that is a specific requirement or constraint which is put down by the customer, and you have to follow that constraint when you are creating the portfolio. Read this first 5 lines. Read the first 5 lines. I'll quickly go towards the next section also. All good. I hope everybody has been able to read that 5 lines. They have also given you references with respect to ethical investing or basically sustainable investing. Okay. Now, what these things bring in, they bring in more restriction for the fund manager. Okay. I cannot invest into a company which is in tobacco manufacturing. You cannot invest into a company which is into alcohol. So that is the requirement of the customer. Whenever you have such kind of a restriction, you should ideally make sure that you have written it down in the IPS. Okay, there might be customers who might have restriction as per the religious requirement, okay, right? So that all of this has to be considered in your IPS statement when you're writing the constraint of the portfolio. Read that paragraph, the next 3 lines. All good. Now let us go to the last part, last section. Okay, the last section talks about that like you have the unique requirement of the customer can also have a unique preference with respect to the diversification need. If suppose he wants to heavily invest into banking sector, he want to heavily invest into infrastructure sector, then that requirement has to be fulfilled for the customer when you are creating the portfolio. Okay, many of the investment managers also clients also come up with a request that what their competitor companies owners are doing and what is the portfolio, the composition they might have. So you want to create similar line of portfolio, that is also available. So read that entire paragraph, the last paragraph of this section. Perfect. Are we guys good till here, guys? Give me a quick confirmation on chat if you guys are able to understand the concept and if you guys are able to pick up the content. Give me a quick confirmation on chat. Perfect, perfect. So let us go towards the next part, specification of asset class in relation to asset allocation. Okay, now this asset class, what does that mean? Suppose if you want to invest into equity, you want to invest into bonds, you want to invest into derivative, you want to invest into commodity. So those are the asset class. So when we decide we want to create a portfolio, you have to decide, okay, how much amount I am going to put in into equity, how much amount I'm going to put in into the bond side, right? So all of this allocation at the asset class level has to be there. Okay, and you have to decide which asset class you will want your investor to put their money into. Okay, so that is the requirement of the asset allocation. Now this is again coming from the IPS, because whatever the requirement of the customer, whatever is the constraint of the customer, based on that you will do the strategic allocation. Like I said, if the customer doesn't want to invest into IT company, then obviously when you allocate share within the equity market, you would not invest into IT companies, right? So read this first 3 lines. It gives you an introduction to strategic asset allocation level. Read that part. Perfect. Right. So first what we will do is we will decide which asset class to invest into and how much amount of percentage I will invest into a particular asset. And once I have decided that, I will go into that particular asset class and then I will decide, okay, which asset to pick from that particular asset class. For example, I decided, okay, I'm going to invest 40% of my money into equity. Okay, then out of that 40% which I have invested into equity, whether I want to invest into banking, whether I want to invest into a particular sector, which particular stock I want to pick, then that is where my understanding or my analysis will come into picture as an investment professional. Okay, obviously at the overall level, I would like to create a portfolio. Which is very much low correlated. Now when I'm saying low correlation, see, I want to make sure that portfolio value doesn't go down if one single asset goes down. So that's the reason the correlation among the asset has to be 1. So that is from the risk perspective what the investor is supposed to know and remember and include. So read this section. The last 2 lines specifically focuses on diversification. Kindly read that part. Perfect. I hope everybody is being able to read till this section. Let us go to this part. Historically, what we have seen that only the broad categories of equity, these are the asset class, equity, bond, cash, real estate, right? These are generally considered by the investment managers when they invest the client's money. Okay, but there are certain other new categories like alternative investment. These are not traditional investment categories, like for example collectibles. What is collectibles? The stamps, or basically there are also investors who invest into painting. There are also investors who invest into antiques. Okay, so those kind of things, artwork, basically intellectual property. So those kind of thing can also be included as an asset class. Okay, there are customers who want to invest into equity. So you as a fund manager, you should definitely, when you are investing or creating a portfolio for the client, you have to think about the traditional products, but also think about the new alternative investment products which are available in the market. Read that paragraph. Perfect. Read that entire section. Perfect. So this paragraph was just to give you a view what all different sector and investor can invest into. Okay, let us go to this next paragraph. Okay, this next paragraph primarily highlights, or it primarily talks about that, okay, when I have decided, okay, I want to invest 30% of my equity, 30% of money into equity. Now further I will do internal bifurcation. Okay, out of that 30% I might have invest only 2% into foreign equity, rest 28% is going to be into domestic equity, Indian markets. Okay, in that 28% which I want to invest into Indian market, I will invest majority into and high blue chip companies or large companies, and rest I will invest into smaller companies. So you will do the further bifurcation as per the requirement as per the constraint given by the customer. Okay, read this paragraph, the entire section. Simple. Now this reference that they gave, they have given you a reference with respect to the equity, but you can do the same thing for the bond. Okay, for example, you have decided, okay, I want to invest 20% of my money into bonds. Now within bonds also there are corporate bonds, there are government bonds, there are municipal bonds, there are foreign bonds also available. There are then within those corporate bonds you can have investment grade bonds and speculative grade bonds. So you can do further bifurcation into the category on the asset class depending upon the requirement that you have as per the IPS. Read that paragraph. Pratham, answering to your query, generally REITs are considered as an alternative investment, but for Indian market it has not been well developed. Okay, that as a route of investing. Okay, for the international market that is considered into the alternative investment. See, because what is happening is these are not traditional tools. Like for example, investing into REIT is nothing but you investing into real estate product. Okay, like you invest into companies through shares. Okay, and because those properties are listed. Okay, so from that perspective, you first of all need to have a knowledge as an investment manager, and then you can ask your clients to you can educate your client, and then only you can go ahead and invest in those kind of assets. These are generally termed as alternative investment categories. Right, Pratham, I've answered your query. Now once you have decided, okay, which investment asset class you want to invest into, and you have decided, okay, what is the further bifurcation that I want to have within that asset class, okay, then you will try to understand what is the overall risk and overall return, and what is the correlation of the entire portfolio. So overall risk and return for the entire asset class, and the correlation within the asset class and at the portfolio level. So they have given you an example for you to connect. They have given you an example to connect a single. See this part over here. They have said, okay, I want to invest into these kind of bifurcation. Look at the passive global equity, 24%, active global equity 5%, large cap, small cap, private equity, all of this is just a bifurcation of how a fund is invested into the market. And they are taking the example of Vermont Pension Fund Committee, which manages around $4 billion. So out of that $4 billion, 24% is invested into global equity, which is passive. That means index. They've invested into index of those global equity. Okay, so they have given you this table just for the reference, so that you can understand how a particular fund is managed in terms of bifurcation. You can look at so many different things which are not explicitly covered in your book also. Okay, because in the book they have just given you the highlight of what can happen with you, or what all areas where you can invest into, but in real life those things are going to be coming in detail. You'll have so many different assets, so many different combinations to create from. Okay, so they have given you the entire table. This is just for your reference. Right, they also have a category which is specifically focusing on inflation related part. So they are investing around 10% of their money into inflation hedging asset. What is that basically? You want to protect your portfolio from the inflation loss that you might have because of the fund. So you are going to invest into that amount. Okay, so read this paragraph. Read this table properly just once. Just have a look at this section. This is just for reference. You don't need to remember anything out of this. This is just for reference. Let us go towards the next part. Describe the principles of portfolio construction and role of asset allocation. in relation to the IPS. Now this part, the principles of portfolio construction, is very, very important, right? Because we have already we have seen in the previous chapter that we talk about efficient frontier. Okay, efficient frontier will have the list of portfolios which are more efficient than the other portfolio combinations which are available in the market. Risky asset. Okay, then we have also seen that, okay, we can create a portfolio which has a risky asset and also a risk-free asset. So this is basically the base of your portfolio construction. Now let us go and read this section in detail. Let us read this first five lines. So what this paragraph is talking about, that okay, when you decide to create a portfolio, obviously you have to look at the risk and return and the correlation, also the efficient frontier logic, but you also have to connect it back to the IPS. What is the actual risk of the portfolio that you want to create, and what is the actual risk that is being given by the client? Does it match? Okay, and you have to give the best return, best combination to the client, the risk and return combination to the client. Read that first 7 lines. Read that first 7 lines. All good? Now, so you will also create an efficient list of combination of portfolios that you can invest your investors' money into. That is one part, and you will try to find that efficient portfolio as per the risk and return requirement of the customer. So you will try to find in that efficient frontier which combination of asset will give you the best possible return and risk combination. That is what has been given in the last one line. Perfect. So this first paragraph is just giving you an overview. The second paragraph is where the main part is going to start. Now look at this section. We have already talked about the strategic asset allocation. That was the broader level where we are going to be investing into which asset class and which security. Okay, now generally what happened is that you do not deviate from that, okay, because you want to create a certain specific type of portfolio, but there might be an asset manager who is actively managing the portfolio. So you might have the strategic asset allocation, but you might deviate into certain asset. That means you might invest heavily into certain asset, or you might reduce the allocation to a particular asset. Now suppose you're managing the client's portfolio and suddenly you realize that one particular stock, for example ITC, okay, you feel that the ITC stock might go up in the future, so you would increase the allocation of your money into that stock, okay, so that your portfolio's return is increased. Okay, so you are deviating slightly from the strategic asset allocation which you had initially decided, and you are moving towards tactical asset allocation, which is nothing but you deviating to give better returns to your customer. Read this entire first 6 lines. All good. I hope everybody has been able to read that first 6 lines. See, properly identify what is strategic asset allocation, what is tactical asset allocation. Okay, now strategic asset allocation is basically the long-term view of the portfolio till that time horizon. This is the allocation that you want to maintain. What is tactical allocation is that you realize that in a short term there might be certain asset where you might gain, so you are changing the composition of the portfolio, you are increasing or decreasing the weightage to get that benefit, and that is why you're tactically changing it. That's the name, that is why the name is tactical asset allocation. Okay, next part of this paragraph, okay, security selection. Okay, security selection also plays a very, very important role. So we primarily said that, okay, when we are doing a strategic asset allocation, we'll first go and identify the asset class, but within that asset class you might have to pick up the individual security. Now think about this. Suppose you have an index, okay, you are following the index, you have created a portfolio which is exactly mimicking the index. Okay, now in the index you might have certain security in a particular weightage. Okay, now you might decide, okay, whether you want to invest over invest in a particular asset, or you want to under invest into a particular asset to map the requirement of your returns. and your risk. Okay, so that is where the security selection process becomes very interesting, because and this is primarily from the perspective of active investment management. Read this 3 lines, the next 3 lines properly. Okay, it talks about overweighting and underweighting particular type of stocks. It depends upon your requirement as a fund manager. Okay, now some investors might also feel that, okay, if I want to invest a certain section of my money, or if you're a fund investment manager, you might feel that a certain section of my money should go into a particular asset class like real estate, like artwork. Okay, so within that you also have to select the individual asset, okay, which matches the overall risk requirement of your customer. Read that last 3 lines. This is just from the perspective of alternative investment, the last 3 lines. Perfect. Let us go to this part, the next section. Now over here we are talking about risk budgeting. This is a new word that we have explicitly come across. Okay, now this is followed by most of the investors. Okay, see, when you are investing into a passive fund, or basically you are creating a passive portfolio, what is a passive portfolio? It exactly matches a particular index. So for example, you are creating an index which matches exactly the Sensex, exactly S&P 500. So over there you might not find the hit of a risk. But if you are actively managing a portfolio, okay, then you would ideally try to manage the risk of the entire portfolio by creating a risk budget. That means, what is the total or the highest level of risk within that portfolio I can take? What is my appetite towards the risk for the entire portfolio level? And I can also bifurcate that. I can also bifurcate that for individual asset class. I can do that for the individual asset class also. Okay, so that when a particular asset class, if I'm taking positions into particular asset class, if that becomes more riskier, then I will come to know and I will change the composition. That is where this risk budgeting will come into picture, because if you don't know how much amount you want to take, okay, you will not be able to compare it with the actual thing that is happening. Okay, so read this entire paragraph. This is the first time we are hearing about this risk budget in the entire portfolio management concept. Read this entire paragraph. Perfect. I hope everybody has been able to read this paragraph. Now the next specific part, the active portfolio management, has 2 specific issues. Mark this entire bullet point as star, very important for the exam from this chapter. Now investor, now look at this point. When you are actively managing a fund, what all problems you might face? The first section talks about an investor may have a multiple manager actively managing the same benchmark for the same asset class. Okay, that means if I'm an investment manager, somebody else is also there, and we are both tracking the same index or same benchmark, and we are trying to beat the same benchmark. Okay, so the weightage of my portfolio, his portfolio, will be slightly different in terms of I am putting overweight into a particular asset, he's putting overweight into some other asset. So our combination of overweight and underweight is more or less similar. Okay, but the ideal logic is that investor will have to understand, if the client need to understand, if I have 2-3 portfolios with a particular fund house, and those portfolios, the investor managers are actively managing the money, and they are taking active bets in the market, they want to deviate from the market, then in that case, at the overall level, if some portfolio is making money, the other portfolio is losing money, so at the overall level you might not be able to make excessive growth in your portfolio, because at the risk level also, if some portfolio is taking lower risk, the other portfolio is taking the higher risk, at the entire client level, the risk is getting averaged out. Okay, look at this paragraph, the next first 3 lines of this paragraph important. All good. Let us go to the next section. Now look at this paragraph. Look at this paragraph. Okay. Now the last section is basically telling you that okay, if you have 2-3 multiple managers managing your money into different asset class, actively managing the money, this can be the situation that you might at the client level you might not be able to manage the risk budget properly. You might underutilize the risk budget. You might not be able to take the appropriate level of risk which could bring the entire return of the portfolio up. Okay, that is what the last 3 lines talks about. Read the same, read the paragraph properly. All good. Let us go to this section, the next part. This was the first problem which investors, active managers generally face, that if the client's money is managed by 2-3 managers, then at the overall level client might not get the entire benefit. Okay, the next section. Okay, if suppose if I'm a client and my money is managed actively by a fund manager and he is doing excessive transaction, he is adding more asset to the portfolio, is removing more asset within the portfolio, then what is going to happen is this will add negative consequences to the entire return of the portfolio. First, the transaction cost is going to be very high. Also, the gain that I have generated, there might be a situation that the tax impact is also going to be very high. Read that paragraph. So that is an effect, side effect, when you engage into excessive active trading or active portfolio management. Read that paragraph. All good. Now let us go to this part, core and satellite approach. Mark this paragraph as also star. Okay. Now what this primarily talks about, that you invest majority. Okay, the core satellite approach talks about investing majority or a core portion, a smaller portion into passively managed index. Okay, or basically investing a small amount into a portfolio which exactly copies the index, and you invest heavily into active management or individual security. So that is basically your core and satellite approach. So if I suppose I have 100 rupees available with me, okay, so what I can do is so it depends upon your portfolio requirement. I can create a portfolio where if I have 100 rupees available with me, I am investing 80 rupees into passive funds which are mapping the market, mapping the index, and invest 20% into active management. That means investing those into individual stocks, individual bonds, which is going to be managed actively. I would exit early, or I would stay there for a longer period of time if the return is there. But this is not going to be passive. This is not going to be a straightforward investing. This is where the mind of the portfolio manager will also get involved. So that is called as core and satellite part. So my core part is invested into passive managed fund, and a small portion, the satellite portion, is invested to generate higher return. That is where I will take the risk. Read that paragraph, the core satellite approach, important for the exam. All good? Perfect. Let us go towards the next paragraph. Okay. Now the last section talks about that. Okay, if you are looking out for the we have decided the asset allocation, but within that asset allocation we want to go and select a particular asset. This is where the manager's skill will come into picture, where we can take the information available in the market and use the opportunity to get a better security for the portfolio. Now, even for a short period of time and also for a long period of time, this is where the fund manager's ability will come into picture. That is what this paragraph, the last paragraph, talks about. Read this section, and they are also highlighting the tactical asset allocation, where the fund manager is deviating from the long-term goal to generate some extra return in a short period of time. That is the last paragraph which you should read properly. All good? Perfect. So let us go towards the next section, learning objective, last learning objective basically of this chapter, where we are going to focus on the ESG. In level 1 we talked about the ESG section, the first part of the corporate finance, where we were looking at how we invest. When you want to invest into particular security or an asset, you take into consideration that ESG factor, right? And we also read about negative screening. Okay, so how exactly you implement it when you are doing the portfolio management, that has also been covered over here. Read this part. Now, negative screening was primarily identifying those security or asset which I would not want to invest into because those does not match my ESG criteria. That is what the negative screening was. So I will look at the entire different types of asset which is available in the market, and I will try to remove those assets which are failing in the negative screening approach. Okay, which are failing in either the E part, okay, then the S part and the G part. That is the ESG section that we had explicitly talked about in the corporate finance book. Read this paragraph. Simple. So this is a very good way to form the portfolio. So what we read in corporate finance is going to be also utilized in the portfolio management approach. Now there is one more approach, which is positive screening. Now what does positive screening means? I will only look for those assets which are best in class, which are matching my requirement of the ESG practice. Okay, so that can be one way to identify either negative or either positive screening. Read that next 4 lines. Read that next 4 lines properly. I hope everybody has been able to read that positive screening part. Let us go to thematic investing. Now, thematic investing is basically a way through which you would only want to invest into particular type of asset. That is the style of investing. For example, I only want to invest into small cap industries, or I want to only invest into large cap companies. So that is my style, or that is a theme that I have picked up, and I'm going to invest and I'm going to create a portfolio into that entire section. So read this part. Thematic investing is available. Read that next 3 lines. This is again repeat from the previous chapter. Simple. Now let us go to the next paragraph, where we are focused on, okay, focused on the proprietorship, or basically the ownership of the companies, or where we are having a position within the board where we are into influential position. Okay, I have sufficient amount of voting rights, like that. Okay, so read this first 3 lines. It talks about engagement and active ownership investing. What does that mean? You are using your position to invest and to promote the ESG investing style. Okay, that is the entire core of this paragraph. Right, so read this first 3 lines. So I would like to focus on investing into those company which matches the criteria of the ESG, and I would like to promote that also, right? So as an investor, investment manager, then you will have to be clear about how the, because see, if you are a board member, then you might have a certain amount of voting right also in a particular company. If you have a particular amount of stake, then how you guys are going to manage the entire voting perspective is also being clearly defined. So read this last 3 paragraph. Okay, how the usage of the voting is going to happen. Okay, is it going to direct the manager to vote on the behalf of the customer, or the customer will come and vote on behalf directly at the time of the voting day and the annual general meeting? So that is also being clearly defined when you are managing the portfolio of the owner or the director of the company. Read that 3 lines which is highlighted on the screen. Right. Now let us look at the last paragraph. What does this last paragraph focuses on? Okay, now this basically try to summarize the entire ESG framework, that if suppose you are managing the portfolio and you are managing the constraint of the portfolio as per the investment policy statement, okay, but ESG factor, managing the ESG factor as a constraint is a very important point, because now since the investors are getting educated, a lot of they want to invest into companies which are compliant with that ESG factor, then you cannot ignore it. Your portfolio will have to take that as a constraint, and then you will have to create a portfolio which is going to be there. Now you know that, okay, if we are going to follow this rule properly, there might be a decreased return, but then you have to inform the customer in advance about this. But what is going to happen if you invest into companies which are ESG compliant, then you are not worried about those things, because it is not having any impact on the social environment, and the governance part will also be good. Okay, so you'll be rest assured that on the long run the portfolios will give you an increased return. Read this entire paragraph, this entire section. Perfect. I am hoping everybody has been able to read that paragraph. Let us go to the solution, the module quiz, the question quiz, module quiz of this part 54.1. Let us go to the first question. The investment policy statement is most accurately considered. Come on guys, I would need your answer for this section. Investment policy statement, is it, now if you look at the option, is it the starting point, is it the middle point of your portfolio management process, or is it the end point? Right? What is this investment policy statement? Is it going to happen at the start, at the middle, or at the end? Come on. Right? People have started answering yes. The answer is A. Why? Because investment policy statement tells you what exactly the client's behavior is going to be, how exactly, what all constraints you face, okay, what is the investment capacity that the client might have. So that is the starting point of your investing. So that is why the answer is A. Okay, let us go to the second component, the component of an investment policy statement that defines that investment objective is most likely to include information about. Now out of these component, which is the most likely, which has to be there in the investment policy statement, that is what this line primarily talks about. Okay, unique needs and preferences of the customer. See, there might be a certain customer where they do not have any unique needs and preferences, but the risk tolerance, which is the A part, is always and always added, because every customer will have its own individual risk tolerance level. Okay, the B and the C part is, it might be there but not for all the customers. That is what the question was primarily asking you, which component is always going to be there. That is why the answer for the second question is A. Right, let us look at the third question. When an investment advisor is developing return and risk objective for a client, okay, then what is the option that is going to be there? Will he look at the returns objective? Will he look at the risk objective? What is going to happen? I would need your answer guys for the third question. Kindly start posting for the third question. Right. So primarily, if you look at the options available, what they are saying is that return objective. We have talked about absolute and the risk part, but both return and risk you can look from the absolute and the relative part. So the answer for this question is going to be C. The third question is going to be C, because both return and risk can be stated in the absolute or the relative terms. We have already read about this. Let us go to the fourth point, guys. Let us go to the fourth point now. Okay, a client exhibit an above average willingness to take risk but a below average ability. Okay, so he doesn't have the ability but he wants to take extra risk. When assigning the overall risk tolerance level, the investment advisor is most likely to assess the client's overall risk tolerance is what? Come on guys, this is very interesting. This is related to the concept that we just now completed some time back. So how exactly you are going to define the risk tolerance level of that customer? Is it going to be above average? No, it's going to be below average. Why? Because he is not having the ability. Even though willingness is there, he doesn't have the ability to invest. Okay, so the answer for this question is going to be C. Yes, it's going to be C. Let us go to the fifth question. Which of the following is least likely an example of a portfolio constraint? Read the word properly. Least likely. What exactly would be the answer? Come on guys. So think about this: significant spending requirement, because that would mean liquidity requirement for the fund. This is actually a constraint. Tax. We have also talked about certain components which are there and which add constraints to the portfolio construction process. So tax was also there, liquidity was also there. Now look at this part: minimum total required return. Now this will not be a constraint when you are creating a portfolio. This is giving you hurdle rate, okay, but this will not create any problem in terms of creating the entire structure of the portfolio. So my answer would be, the fifth answer would be C. I hope everybody is looking at the content and answering properly. The fifth question will be C. Let us go to the sixth question. For an asset allocation purpose, the asset class should be specified such that the correlation of returns are relatively what? Within the each asset class. Come on guys. This was also there. The sixth question. There was a statement explicitly stating about it, right? Now within the asset class, if the correlation is high, that is okay, but across asset class, that means equity, bond, commodities, that has to be very, very low. That has to be very, very low. If you read the content in the previous part in the chapter, they were explicitly talking about low correlation among the asset class. Okay, so that is basically the B part. That is basically the B part. Okay, so sixth question, the B part is the answer. Let us go to the seventh question, the final question. Come on guys, what is the answer for this question? In determining the appropriate asset allocation for the client's investment account, the manager should do what? When we are doing the asset allocation, what is the one step that he has to follow? Okay, now this is not the start of the portfolio construction. So this is not where we will look at the investor's risk tolerance. This part is going to be at the start. I'm doing an asset allocation. So over here I have to look at whatever asset I'm going to pick up, what is going to be the future growth in that asset. That is why the answer for this is B. I'll not focus on the risk tolerance level at this point. It has to be done at the start. So the seventh question, the answer for the seventh question is going to be B, right? I hope everybody has been able to completely read the chapter and look at the solutions properly. Give me a quick confirmation on chat, guys. Perfect. Give me a quick confirmation on chat that we've been able to understand the chapter. We've been able to go through the entire content of the chapter and also the immediate quiz that we saw, right? Perfect. So thank you very much, guys. We have completed this chapter and thank you very much for the time. And the people who are new to this session, so primarily I'm Ganesh Naik and I take sessions for FRM and CFA training, and we basically provide live online sessions for CFA, and also we take video lectures. Okay, for video lecture packages is also available for students who wish to prepare on their own for the CFA exams and for the FRM exam, and we try and help the students to clear the exam in the first attempt. Okay, so we'll be coming up with more such session in the future. Till then, stay tuned and stay happy, and thank you very much for joining in, and we will be doing more such exciting session in the future.